stocks spent much of the day in negative territory as those worries about the global economy that Erica just told you about weighed on Wall Street. But late buying in the blue chips turned the Dow positive. It closed up almost 19 points. The Nasdaq fell 6. The S&P down almost a point. Joining us now for more analysis, Nick Colas. He's Chief Market Strategist at Convergex. So, Nick, that economic data from China certainly got everybody's attention this morning. And some people are even wondering whether the economy in China is slowing more than we think. What are your thoughts on that?
Well, it's very clear the Chinese economy is slowing. That number is actually not all that disappointing, but it was the 11th straight month where Chinese producers said that business is slowing. So China is clearly on a slower growth path and one that could easily tip over, particularly given the political wranglings that we've seen with Japan most recently.
All right, so China is slowing. Europe is in a recession. What does all this mean for American businesses and the Federal Reserve's promise to save the economy and to create more jobs?
Well, it's very clear the Federal Reserve has a long road ahead of it. The global economy, as you rightly point out, is slowing. The U.S. economy is not in great shape as it is. Unemployment's still over 8%. And so the Federal Reserve, through the plans it announced last week, is really trying to push liquidity into the system to grow the economy further. Same with the ECB, same with Bank of Japan. Central banks around the world are trying their level best to get the economies going again, but it's a very tough slog.
And you were telling me that even though these central banks are putting a lot of stimulus into the economy in every corner of the world, that the global economy is headed for a recession. Tell us why.
Yes, it's very clear that recessions are a normal course of the economic landscape. They come every 5 to 7 years. We're 4 years into a recovery, and so I think it's very logical to worry and at the same time expect a recession, perhaps a global recession as early as next year, given all the data that we're getting currently, even with the impetus of all these central banks pushing liquidity into the system.
All right, so what does all of this mean for investors and for the stock market? Are we going to see a pullback because of all of these recession concerns down the road?
Well, it's very clear central banks are trying to maintain equity markets where they are currently, so I don't expect a big pullback, but I don't see a lot of room for upside either. I think the smartest way to go is a diversified portfolio, and I think the single asset class that protects investors the best are things like corporate bonds, high quality corporate bonds, solid companies with good credit ratings.
Yeah, let's talk a little bit more about that, what the options are, because most investors, especially the ones who are risk averse, are concerned about putting their money still in equities. And on the other hand, there are very few places where you can get, because of low interest rates, where you can get some good yield. So, all right, you say corporate bonds. I mean, what else? And even with corporate bonds, what are you talking about, 3%?
That's right. It's very, very tough to get yield here. There are a lot of investors, a lot of institutional investors interested in dividend-paying stocks, and that's a reasonable strategy as long as they're very well diversified. But you have to remember that you can lose the 3 or 3.5% on a portfolio of stocks in a day or two of a bad market, and then you've only got that yield to make it back over the course of a year. So stocks are still going to be volatile, no doubt about it.
All right, we'll leave it there. Thank you so much. Nick Colas of Convergex Group.